24 seconds away from the opening bow this morning. Good morning to you all. On a bit of a winning streak on the S&P 500, just a bit softer at the moment going into Chairman Powell Day decision this afternoon. Equity futures down by 0.2% on the S&P. Some underperformance on the Nasdaq driven by what's developing in Microsoft after the close. There's your opening bell with equity futures just a little lower on the Nasdaq too. Let's turn to the bond market. Yields are lower by a couple of basis points, 386.28. In the FX market, the euro bouncing back, 6 consecutive days of euro weakness, replaced by a little bit of strength. Euro dollar 110.68, we're positive there by 0.1%. WTI just short of 80, $78.88. We're negative there by almost 1 full percentage point. About 20 seconds into the session, the S&P 500 looks a little something like this. We're negative 0.2%. On the Nasdaq, we're just a bit softer as well. The stock to watch at the open, Microsoft, the company posting tepid sales growth and forecasting a continued slowdown within the cloud business. The CEO saying this: we remain focused on leading the new AI platform shift and helping customers use the cloud to get the most value out of their digital spending. Abby has more. Hey, Abby.
Hey, John. Well, it's not surprising that this stock is lower right now, on pace for its worst day since the beginning of June, down about 2% or so, given the fact that on the year coming into this report, it had been up somewhere closer to 50%. So price to perfection to some degree, and that revenue growth slowdown that you're talking about, the revenue growth of the quarter that they just reported, about 8.3% on that cloud slowdown, not offset by optimism around AI, saying that AI is going to be a little bit, it's going to take longer to get it going, whereas the cloud, that's 41% of their business revenue. So I think that the big concern here, John, is that we could see this slowdown continue. And if you look back at Microsoft over time, between 1999 and 2016, it never made a record high from its bubble peak because of that slowdown. If you look at the Microsoft modeling right now, it has been in single-digit growth for quite some time. So I think, again, the fear is that it will stay stuck here and that that's going to weigh on the stock.
Pretty sure Joe has a moustache now and long hair. Abby, thank you. Very different look. Abby, thank you for that. Just around the opening about 2 minutes in then, equities down just a little bit. Abby went through one of the losers, Microsoft, one of the winners, Alphabet, topping Q2 estimates thanks to robust advertising within its search business. The company saying this: generative AI is supercharging new and existing ad products with tons of potential ahead. Mandy, good to see you again. They're saying all the right things. Are you seeing it turn into real money?
Well, so look at how Google is going to grow their top line going forward. One, they have that daily active user base of 3 to 4 billion users through the search product. So they're not going to add more users. They're going to focus on driving engagement. And that was one of the biggest risks with ChatGPT, is can it take away the engagement? And I think when you parse out Google, as a combination of search, maps, and all the apps they have inside, that is where, a Bard or the next version of generative AI could be very powerful in terms of driving engagement. They missed the boat with social media, but I feel that's what they're focusing on. How do we drive engagement? And I think they said all the right things last night.
Mandy, with that in mind, what does the president and chief investment officer do at a tech firm?
Well, so I think Ruth Porat's elevation is not a surprise given, how well she did with cost cutting this quarter, and they need that focus when it comes to driving the bottom line. I think if you're thinking this company can compound EPS at, low to mid-teens over the next 5-10 years, you need both the top line focus and bottom line. And I think Ruth has that experience, both with her street experience, taking stakes in smaller companies, because Google obviously can't buy any company now, and I can see more of that happening given what Microsoft did with OpenAI early on.
Mandy, just quickly, Meta later. I asked you briefly about the read across from Alphabet to Meta, thinking that perhaps we get a lift for Facebook too, and you picked on Snap, and I'm going to talk with Simone about Snap in just a moment. Yeah. Why is Snap the cleaner read on what may or may not happen with Meta later?
Well, so social media advertising is different from search because, the advertiser base is more concentrated, although in the case of Meta, it's mostly small businesses, and we know small business sentiment is improving. I think why Snap didn't do well is, one, a function that their engagement growth somewhat tapered, and that's because of TikTok and all the competition, from Instagram. But I do think, ad pricing has been slow to come back. And right now, what we saw is probably advertisers focusing on the highest ROI spend, which is Google search.
Mandeep, thank you, sir. Snap getting absolutely hammered this morning by almost 20%, a fifth of the market cap, just like that, in the first 4 minutes of trading, getting slammed after delivering a disappointing guidance. The company saying this: we remain in a period of rapid transition as we work to improve our advertising platform despite limited visibility for demand. Simone, that does not sound good, does it?
No, it doesn't. You don't love to hear a rapid transition. Net loss coming in a little bit lighter than anticipated, but as you pointed out, John, it's all about that revenue forecast. This second quarter was the second straight quarter where year-on-year revenue fell, and then when you look out to the third quarter, Snap looking at for $1.07 to $1.13 billion in revenue. Analysts we're looking for that top number. I think you're seeing somewhat of a comparison of what happened at Alphabet, just such strong commentary around ad revenue. Meta's ad revenue expected to come in pretty hot as well, and there are rising costs as Snap invests in things that will draw more consumer engagement. 70 cents per active daily user, up from 58 cents a year ago. There are a handful of encouraging signals, however, if that's really what you're looking for and you believe in the Snapchat product. 397 million daily users, that's up 14% from a year ago, especially strong user growth outside North America. John?
Tell that to shareholders this morning. We're down 20%. Simone, thank you for that. That one brutal, ugly around the opening bell. Let's turn to semiconductors. Texas Instruments posting a weaker than expected Q3 outlook. The CEO saying this: similar to last quarter, we experienced weakness across most of our end markets. Katie has more. Hey, Katie.
Hey, John. Even with the bright spot in the automotives, Texas Instruments currently down by about 5% as trading kicks off after delivering a pretty lukewarm forecast. The chipmaker sees third quarter revenue coming in between $4.36 billion to $4.74 billion. Now, the midpoint of that range is below the average analyst estimate of about $4.59 billion. And again, automotive, it was the bright spot here, but outside of that segment, you heard from the Texas Instruments CEO saying that customers, they're continuing to cut their orders of new chips. They're instead choosing to rely on their existing stockpiles, and not to mention you also have order cancellations hovering near elevated levels. So you add that all together, of course, it's weighing on the stock this morning, and it could have implications for the broader industry here, given that Texas Instruments usually seen as a bellwether, John.
Stock is down 5%. Katie, thanks for that, breaking it down for us for the semis and beyond. We're about 7 minutes into the session. Equities at the moment negative by, let's call it 0.2% on the S&P. On the NASDAQ, down by a little bit more. It's a monster week for big tech, but better news could be in other sectors.
I think tech is going to be a loser. Why would you pay 40 or 50 times earnings when you can get companies with superior earnings growth that are cyclical at a fraction of the cost?
There's a lot of anticipation and good news already priced into the mega cap names. There are opportunities elsewhere. We do think that this earnings season could be a catalyst for a broadening out of this rally.
We've heard so much of that over the last few weeks. Victoria Fernandez also looking beyond just the tech sector right in this. We want to be invested but remain cautious throughout the second half. Stay invested and find the parts of the market that will perform best in certain environments. Industrials have begun to show some leadership. Use this sector for some cyclical exposure. Victoria, I'm pleased to say, joins us now. Victoria, let's go straight to it. Why do I want to buy cyclicals with month after month after month of declining leading economic indicators and an inverted yield curve?
Yeah, it's a great question because, as you know, we actually anticipate a slowdown later in this year. So you're right. Why do I want to be in cyclicals? But I think it's because you have to have a balanced portfolio, Jonathan. So many people have been focused on that tech sector. And you know, for a long time, we were actually trimming those high-flying names because we didn't want to have so much exposure to those names. And we were looking in other areas within tech. But at the same time, we said, look, you can't underestimate the consumer. We do think there's going to be a pullback later this this year, but the consumer continues to spend. We heard it from Visa, where they said they don't really see that much of a slowdown in consumer spending. So I think you need to have some exposure there. Like I said, industrials have been taking a leadership role, so maybe you can look at some of those names. Construction has actually been moving higher. Manufacturing construction of plants has actually doubled in the last 12 months. So look at some companies maybe associated with that, and I think you also want to have some staples in your portfolio just to give you that diversification within your portfolio for the volatility we see ahead.
Well, talk to me about what's funded that. I'm looking at what you've trimmed. Hilton, Bank of America, Kroger. Why those three names? Do they have anything in common?
Well, what they have in common is their outperformance over the last month and the trends that we're seeing. So obviously there's been this whole revenge travel going on all summer, but we heard from Alaska Air yesterday where they're seeing domestic travel really start to slow down. We saw Southwest come down a little bit because of that. So domestic travel coming down means hotels will probably not do as well. Hilton has had a really strong month. They were up over 10%. So trim a little bit of that name. You don't have to come out of names completely, but take a little money off the table, appreciate your wins. It's the same thing with Bank of America. 10% in a week, why would you not trim some of that and look for other areas, names that have been hit, and put some money there? And Kroger is the same way. They've had strong performance, 5% performance as of late. We're starting to see food inflation maybe go back up again. You look at grains, especially wheat. We're seeing commodity prices move up, so there could be some margin pressure there. Go ahead and take some wins. That's the theme across the names.
So this is the equity market. My question to you to start this conversation, why buy cyclicals with the data going in the wrong direction, the leading economic indicators? Why buy cyclicals with an inverted yield curve? Here's the question on credit. Why do I want to buy credit as defaults start to pick up? Make sense of that for me.
Well, it depends on where you're buying within credit. I agree, high yield spreads are so tight right now. And to me, that's a warning sign in the sense that we know if there's going to be a slowdown, we know if there's going to be margin compressions coming in as inflation comes down and pricing power is affected, those high yield names are going to be affected first. So I would avoid high yield. I would look at investment grade names. And within that sector, yes, spreads are tight, but I think those companies that have strong balance sheets, that have good cash flows, those are the names you can have bonds in, whether it's short term to get higher yields on the short end, combined with a barbell on the longer end of the curve to lock in some yields, because I think yields are coming down. We probably hit that peak yield back in the fourth quarter of last year for this cycle. So if yields are coming down and you've got good quality credit names in your portfolio, you can cash in on your coupon and maybe get a little bit of spread tightening still with those names, and you'll be well positioned.
We've been talking for more than 5 minutes and haven't even mentioned the Fed on Fed decision day. So here's a dangerous question. Do you care what Chairman Powell's got to say at 2:30 Eastern? Does it make a difference to your investments that you've just walked us through?
It doesn't make a difference in the near term, Jonathan. We know they're going to hike 25 basis points, or at least I say we know, 99% on the futures say that. And they're probably going to be hawkish. I think people are anticipating that. I don't think there's going to be any surprises that are going to change my outlook on the economy. I think we're going to wait and see what is said at Jackson Hole. We know there's a longer time period than usual between this meeting and the September meeting. Jackson Hole's right in the middle. Let's see if that's where they start to change their story a little bit. That's going to be more interesting to me than what we hear today.
Interesting. Victoria, thank you. Victoria Fernandez there, Crossmark. On this market, what she's been trimming, what she likes in equities and in credit, and looking ahead to Chairman Powell a little bit later at 2:30 Eastern. Just to go through the calendar for you, August 10th, that's going to be an inflation print. Then on September 13th, another CPI read. So they're the two CPI prints between this Fed meeting and the September meeting, which takes place at the back end of September, around September 20th, I believe. Back end of August is when you get Jackson Hole and potentially an address from Chairman Powell. Any rush to commit to a pause? Today in the news conference, as consensus stands, the belief is there will be no rush to commit to a pause later on this afternoon. We'll see. Full coverage, of course, coming up a little bit later on Bloomberg TV and on Bloomberg Radio. Coming up on this program, looking ahead to Meta earnings.
When we look at the performance in some of these big tech companies so far, what we need to wonder is how sustainable it's going to be.
It is one of the big winners of the year so far. That conversation up next with Loop Capital's Rob Sanderson.
When we look at the performance in some of these big tech companies so far, what we need to wonder is how sustainable it's going to be. And AI is an exciting story, and eventually it's going to translate into earnings, and there's no question about it. What we need to determine is how much time it's going to take.
Microsoft and Alphabet setting the stage for Meta after the closing bell. Investors looking to earnings to justify the stock's monster gains this year. Year to date, Meta up by more than 140% already in 2023. Katie Greifeld has more. Hey, Katie.
Hey, John. Well, we'll see if the year of efficiency continues to pay off for Meta. Of course, even though shares have tripled since November, that was off a 7-year low. And if you look at valuations right now, Meta currently trades at 20 times its projected earnings. That's a lot. But then you look at the NASDAQ 100, and that trades at 26 times. So we'll see. That's the valuation backdrop. But I want to talk about the fundamental story for Meta because it is fascinating. Of course, there's going to be a lot of focus on the metaverse. Of course, maybe we'll figure out what it is. There's going to be a lot of focus on ad sales, of course, given that Meta derives nearly all of its revenue from advertising. And there's going to be a lot of focus on Threads. Of course, that's Meta's challenger to Twitter. It launched this month, Twitter, now known as X. There's a lot of lofty projections for what Threads could deliver to Meta's bottom line. Evercore, for one, estimates it could generate $8 billion over the next 2 years. I'm sure we're going to hear a lot about it in the next few hours.
Katie, thank you. I think we're all waiting for this one. Year to date, Meta up by close to 150%. Luke Capital's Rob Sanderson looking ahead to results, saying this: recent conversations with advertising industry contacts point to continued resilience in digital ad markets and are particularly encouraging. Rob, I'm pleased to say, joins us now. He has a buy rating on shares of Meta. Rob, I've been looking forward to catching up with you because I was reading your research yesterday evening, and this is a line you don't usually read around a name that's up triple digits year to date. Sell-side expectations for Meta look conservative. Rob, what's conservative about them?
Well, I think people have accurately captured the cost reductions, and that's been the bulk of the revaluation in the stock this year, and that's less interesting to investors. I think the efficiency is certainly important to the bottom line, but it's sort of a one-time thing, and it's priced into the stock. What we're excited about is revenue acceleration, and I think we're looking at like we heard from Google last night, pretty healthy trends in ad markets compared to what was initially a very cautious expectation. So, better than expected, I think, is the takeaway versus the backdrop. But Meta's really getting its mojo back in product, and that's, I think, very important for the stock and for the multiple.
Before we get to product, let's just sit on ad spend for a little bit more. Rob, I had a guest on a little bit earlier this morning who had a different opinion on things and said that maybe Snap was a better read on ad spend than Alphabet rather, for the likes of Meta. Why is Google a decent read compared to, say, what we heard from Snap?
It's about 70 times larger in terms of advertising dollars. Snap's a very small player in a big ocean. Obviously, the revenue scale of Alphabet is unlike anyone in the space, including Meta. But Snap is a very small player. I think moving through some very company-specific issues, and the incremental dollars there really wouldn't move the needle for a company the size of Meta or Alphabet.
You mentioned product as well, so let's switch to that. Threads.
Sure.
Rob, is it too early to get excited about Threads?
I think so. I think Threads is very nascent in its, it's a curiosity at this point. Certainly has long-term potential, but again, Meta's business is really driven by the core apps, and they're so scalable. Even if Meta were to replace Twitter's revenue base completely, it's like 5% of advertising revenue for Meta. I think it's quite early to be excited about Threads from a moving the stock perspective. I think it's really about the core ad products, and Reels is really the star of the show here, not Threads.
What are you seeing in Reels, Rob, that you think can underpin a re-acceleration in revenue for a company that large?
Yeah, well, the engagement growth has been phenomenal. That's something that's been, I think, known for some time. The time spent on short video products, TikTok obviously very well known. But Reels is distributed to, Meta has 3 billion daily active users. The reach is unparalleled. And now it's not just engagement growth. We're really hearing strong indications from the ad buying community that, the platform's performing very well, not just for brand objectives, but now for lower funnel, performance objectives as well. And a lot of money is moving into this exciting new format, delivering fantastic results for advertisers. And I think there's a lot more to come here.
I'm with you on the doom scrolling, Rob. I've now set a limit on my phone to about 2 hours because of these short videos, which you just keep sweeping through. Rob, can they actually make that much money from advertising on that?
Yeah, they can. The engagement's phenomenal, as mentioned, but it's working. And that's what we're encouraged about. Is when we talk to advertisers, they're getting results, and they see a very significant amount of headroom to continue to put more money into this format. And that's on top of what is already working in stories and feed and other formats across the Meta platform. The other product story is on Advantage Plus. This is an ad platform for advertisers that's using AI to help manage campaigns very early in its ramp, and again, feedback's been incredibly positive. And together, I think this is really helping Meta get some of its mojo that was lost over the past few years. Their reputation in the ad community is certainly on the upswing.
Super addictive, that's for sure. Rob, enjoyed this. Thank you, sir. Rob Sanderson there on Meta, coming up a little bit later. Just things you don't usually hear. Triple-digit gains, and you've got an analyst bullish saying that maybe things are too conservative, switching the focus from the price cuts driven by the collapse of the stock at one point last year. And now we're talking about the product and a re-acceleration of revenue. Meta seems to be getting it done. The results coming up later. Let's see if they can disappoint or impress with a pretty high bar going into results. From New York this morning, your trading diary up next.
Questions.
Equities down just a little bit. That's the price action. Here's your trading diary. What an afternoon. Chairman Powell coming up at 2:30 Eastern. Decision time at 2 p.m. Meta after the close tomorrow. An ECB rate decision. US GDP onto Friday. We round things out with the BOJ. We round things out later with a stacked lineup for Fed coverage. Bob Michael at JP Morgan Asset Management headlining that for you. Plenty of others as well. Looking forward to catching you a little bit later from New York. This is Bloomberg.
the financial centers of the world. This is Bloomberg Markets with Alex Steele and Guy Johnson.
It's 30 minutes into the U.S. trading day on Wednesday, July 26th. Here are the top market stories we are following for you at this hour. It's Fed Day. The FOMC is set to decide at 2 p.m. with the market expecting another 25 basis point hike. The question is, what comes after that? Ellen Zentner of Morgan Stanley will give us her view. A tale of two tech titans. Alphabet beats as Google search withstands new competition from AI chatbots, while Microsoft is waiting for an AI products boost as its cloud business slows. Meta is up next after the bell. And combined to conquer, PacWest is being bought by smaller rival Bank of California to shore up confidence and navigate the upheaval in regional banks. We'll have the details on the tie-up. From Washington, I'm Kaylee Lyons with my co-host in London, Danny Berger. Alex Steele and Guy Johnson are off today. Welcome to Bloomberg Markets. And Danny, happy Fed Day.
Happy Fed Day, Kaylee. I'm about to commit a cardinal TV sin on this Fed Day, so just bear with me. I really think that this is probably the least exciting Fed meeting in 2 years. We know what they're going to do. They're going to hike 25 basis points. I mean, I guess it's what comes next, but I don't know. I can't imagine that this is going to be anything shocking off of these markets.
Okay, I'm with you that the decision itself may not bring any fireworks, but I feel like the press conference could. The idea that it all is about the forward look and the messaging from Chairman Powell is going to be incredibly important. I think his job may be a little bit more difficult this time around, trying to reflect consensus on the committee that may be starting to break down in some way between the Hawks and the Doves. So I actually think it could be pretty interesting come 2:30 p.m., if not right at 2 p.m.
And I will say the data certainly making things interesting. Kaylee, some data to break right now on new home sales for June. Coming in weaker than expected. 697,000 is the annual rate for June new home sales. The estimate was for 725,000. Have we seen a peak in this housing market? That would certainly be good news for the Fed, Kaylee. It could mean that, hey, another piece of data, maybe things are cooling off to their liking.
Yeah, but it's kind of like you can pick your data point because we have seen this tightening of policy transmit into the housing market because mortgage rates are higher, right? Where you're not necessarily seeing it transmit at this point is in the labor market. It's still incredibly resilient. And is that really what the Fed is looking for as it tries to get inflation back down to 2%? Hopefully we'll get some clues from Chairman Powell on that later today.
Yeah, do they need to see the white of inflation's eyes and this job market to really be convinced? And Kaylee, that brings us to our question of the day. Is it July and goodbye? Is this the last hike of this hiking cycle? Joining us now to discuss this is Ira Jersey of Bloomberg Intelligence. Ira, what say you? Is it July and goodbye for the Fed?
Yeah, it very well may be. If you look at a lot of the data that we look at to determine the path of future inflation, it does seem like inflation is slowing and maybe will be trending down enough for the Federal Reserve to take a break. Now, you know, even if we know that they're going to hike today, right? It's a done deal. They're probably not going to hike in September, but they will never preclude another hike in November until we get to November. So I think that we're in a situation where the market's going to, probably take today more or less with stride with a lot of nuances. I agree with Kaylee. I think that there's the distinct possibility that between Powell's press conference and some tweaks to the statement, you can get some fireworks. But it's really going to be the September meeting and that, again, updated summary of economic projections that really we're going to be looking out for.
Okay, so if most of the excitement is actually going to come several months from now, Ira, I guess it begs the question of if the market's just going to keep on keeping on with its expectations that at this point it looks like they think the Fed may actually pull off the soft landing, that it's not going to be an outright recession, but also that cuts are going to come by next year. And I wonder if the messaging around that on when policy may actually ease is going to be what they cling to.
Well, I think that's been one of the biggest issues that Chairman Powell has had, is really communicating what the forward stance was. So for ages, Chair Powell has been saying that the Federal Reserve is not going to cut interest rates anytime soon, that they're going to keep interest rates at a relatively high level for an extended period of time. And the markets never believe that. The market keeps pricing for interest rate cuts to begin 6 months after they end hikes. So the market right now is thinking, oh, they might cut one time in early 2024. Look, the Federal Reserve is probably not going to make any kind of interest rate move in 2024 until you see two things. One is you have their preferred inflation measures below 3%. I'm not saying that's necessarily a hard floor for such an action. And secondly, and this is most important, and the reason why you can say that they've kind of engineered the soft landing, we haven't seen any job losses. Until we have job losses and or a significant increase in the unemployment rate, you're not going to see the Federal Reserve be in any kind of hurry to start cutting interest rates. So you still might have 18 months potentially before they start cutting rates.
Ira, what's the risk we've got this wrong, though, that the Phillips curve lied to us, that you don't need to see those job losses to see inflation come in? And then don't we have this risk that the Fed keeps things restrictive for too long if that is the case?
Well, I think that is a big risk, and quite frankly, that's what we think is going to happen, that the Federal Reserve is going to remain on hold longer than the market expects, and ultimately you'll have inflation come down, and we'll wind up having a real recession. But no, not soon, right? That's the difference, is that you're talking about the second half of 2024, maybe 2025, and our view is that once it becomes obvious that the Fed needs to be cutting interest rates because inflation is finally dead, that they're going to have to cut interest rates much more quickly than the market's expecting. So, and when you look at options pricing for the end of 2024, really the market is saying, oh, the Fed's going to cut maybe 50 basis points or 200 basis points in 2024. So the market doesn't have this 100 basis points of cuts built in. That's the average of what the market's expectation really is. But the market is really worried that the Fed might make that policy mistake that you just described.
All right, well, we'll see what we get come this afternoon. Ira Jersey of Bloomberg Intelligence, thank you very much, as always. Now, let's get another take on our question of the day now. Is it July? And goodbye. Ellen Zettner, Morgan Stanley chief U.S. economist, is joining us now. So, Ellen, do you think this is it? Is this meeting and this hike today going to be the end of the Fed's hiking cycle? And even if it is, can they say that?
Yeah, so look, Ira gave some great insights, and we do believe that this is the last hike of the cycle. But no, there's no way that the Fed would signal that. I mean, being data dependent, they have to see the data come in that continue to prove that inflation is softening in line or even below their forecast, which we expect, and softer job gains. Just the inflationary pressures or inflationary process in the economy just continues to recede, and it's too early to determine that. And also, look, this is a boardroom of folks around the table that disagree. And so what are the disagreements? How many more lags of policy have to come through to impact the economy? How much would inflation come down further? They've got different outlooks. And you've got hawks and doves that have two different opinions of where the path for policy should go. So typically when views are all over the place, it leads to policy paralysis, and they just have to take it meeting by meeting.
That is so interesting because, Ellen, it only has been recently, it seems like we're starting to see those cracks inside the Fed, at least cracks that are starting to be publicly voiced. I think of Bostic, for example, on this camp. Do you think we're going to start seeing more of that, of more outright and open disagreement among FOMC members?
Look, I think that that's typical, and I think we have been seeing it play out. And what happens is when there's no particular emergency, views can be all over the place. And of course, under past Chair Bernanke, it was encouraged that all policymakers voice their views publicly. And so I would expect, while there's no particular emergency driving them to come to a consensus, that you will hear disparate views quite often in the media. When you're making decisions by committee and there is a particular emergency, you will see how quickly they come together and make a consensus decision. But this is not that time, and so they can continue to take their time to make decisions as the data come in.
Well, if there's anything they all agree on, though, Ellen, it seems to be that 2% is still what they're targeting, that they want to keep fighting the fight until they see 2% once again. I just wonder if ever realistically they are going to see it, or is 3% the new normal post-COVID in this new economy?
So you bring up a great point. You know, is 2% normal? Is 3% the new normal? This is something that's going to be hotly debated next year as they start to ramp up their discussions around how they want to change their framework for making monetary policy, conducting monetary policy. And so I'm in the camp that I see nothing that's changed in terms of the cyclical process for how we develop inflation. Right now, inflation is softening, not just because things are normalizing in a post-COVID world, but because households are trading down. There's a substitution effect. That substitution effect drives inflation lower because these inflation metrics are demand weighted. And so to me, there's nothing that's changed cyclically about inflation. We're going to continue to see some normalizing post-COVID. And it's more a matter of how quickly do we get back to 2%? How restrictive does the Fed need to be to achieve or feel like it's going to achieve that 2% goal? I don't think that they're going to change the goal because we're not meeting it, but that doesn't mean that it won't be debated in the next monetary policy framework review.
If nothing has changed in the cyclicality of inflation, Ellen, has anything changed in the transmission of policy in this modern economy? We talk about long and variable lags. The question seems to now morph, is it not that there are lags, is it that transmission is lessened, that what is equilibrium with policy has changed? Are we in a new norm in that regard?
We could be. Look, we know that we're in a different situation this time where whether it's because you think that policy is just not as effective or you think lags are just that much longer, you know, that's going to be open for debate for quite some time. And even the FOMC has no particular agreement there. I think what we can clearly see in this cycle that's unique is that the household balance sheet is locked in at a very low fixed rate. That's what happens when you leave rates at zero for so long, is that you get a gradual transformation of the household balance sheet into low fixed rates. And so we knew from the outset that when the Fed started raising rates, given the amount of cushion, you wouldn't see interest on the debt, which is what really can cripple households' disposable income when interest rates are rising. You just wouldn't see that impact on the economy. And so that cushion, I think, has just been much greater than anyone expected. And then you put fiscal stimulus behind it, which has had much longer tails, I think, than anyone expected. It was only back in March that the largest COVID program supporting households went away. And so it's quite long tails. So there's just more of the battleground is larger for the Fed to cover this time.
Yeah, Ellen, we were speaking with Dana Peterson, the chief economist over at the Conference Board yesterday, about the fact that consumer confidence is at the highest in 2 years. And she cited many things you were just talking about. The idea that they did have, consumers had these built up savings from the pandemic, that the labor market is still strong. People still feel confident that they can find work and the inflation is tracking lower, all of that making them feel pretty good. I just wonder, as we have this conversation about if that means we're heading toward a soft landing, if it's actually counterproductive, if the consumer feels too good and we could end up with a reflationary spike down the road because demand never pulls back in a meaningful enough way.
Yeah, so I think, look, our investors are thinking about that as a possible outcome. I think that we have to underscore that there continue to be two-sided risks to rates once the Fed pauses. The next move after a lengthy pause could very well be up because you get a resurgence in inflation. And I think that has to be an outcome that is judged as a possibility. Now, I don't think you're looking at that sort of outcome until sometime into next year, but it is a possible outcome. I would just underscore that when we talk about households being resilient or demand not falling, we're really just talking about one small segment of households. It's really the wealthy that are spending. The lower income groups pulled back on discretionary spending last year as they blew through the excess savings. There's not any cushion left for low-income households, and we've seen them pull back. But the wealthy, the top income quintile represents 40% of all consumer spending. We want what we want. Everyone's still traveling. Everyone wants their services and are willing to pay whatever for it. And so that is propping up aggregate demand in the economy. And it's a global phenomenon, not just the U.S. And so unless the wealthy stop spending, it will just look like simply a slowdown in consumer spending overall, but not something that falls off a cliff.
Alan, can I bring it back to today? I think I made both Kaylee and our BI analyst, Ira Jersey, mad by saying I thought today was going to be boring, but it's because Ellen and I live for the drama, and today is about nuance. I mean, we don't get a dot plot, we don't get updated forecasts. So for you, what is the single most important thing that we can learn from today? What do you want to hear from Jerome Powell or changes in language to the statement?
So I think, look, changes in language to the statement, even when they change one word, and this is something that Bernanke had described in his book, they can spend hours arguing over one word. And I think what's important is that we heard from Waller, we heard from Mary Daly that recent readings on inflation have softened. So to me, it's been said, but once you memorialize it in the statement, right, it has more oomph, if you will. So if they acknowledge that recent readings have softened, even though they'll still say inflation remains elevated, right, that tells me that the dove still